So thanks all for coming. Just before we start, just raise your hands if you are familiar with DeFi, and raise your hand if you used a lending protocol in the past. Okay, great. So I'm pretty sure you know what's DeFi goal, which is about bringing a better financial system, which is more open, capital efficient, and permissionless. And this market is being driven by DAOs and DeFi protocols, and those DAOs and DeFi protocols are working on bringing more features, use cases, and optimization to the table to continue enhancing the overall market experience. And it's kind of ironic to see that even though those DAOs and DeFi protocols are working on cutting-edge financial products, they still don't have access to the most basic forms of funding that exist in the traditional financial systems. And so that's why today I will be walking you through on how Web3 actors can benefit from under-collateralized loans. A few words about me first. My name is Alexis Masseron, and I'm the CEO and co-founder of Atlendis Labs, which is the main technology provider of the Atlendis protocol, which is an under-collateralized lending protocol. I've been working in the crypto ecosystem since 2017, and I was previously a software engineer at ConsenSys. I'm also a strong believer that the DeFi mission is to bring a more open, trustless, and efficient financial system to both people and institutions. And if you want to see that mission being fulfilled, we first need to take a look at the DeFi lending market right now. And it's not really pretty. Most DeFi lending applications are over-collateralized, meaning that you need to lock more funds in the protocol that you want to borrow in the first place. And that's mostly come from the fact that those protocols are peer-to-peer oriented, which makes sense, right? Because the risk of counterparty is very high. But that prevents corporates to actually have access to fund their activity through debt, which is an extremely common method in the traditional ecosystem. And if we want to have strong DAOs and DeFi protocols that can compete and work with the traditional ecosystem, we need to build the infrastructure to allow those entities to have access to such financial products. And that's why we see more and more DAOs and DeFi protocol having access to liquidity through dilutive methods, such as raising funds through VCs. So they sell their tokens. And this is good when you want to kickstart a project or you want to scale it when needed, but it comes with a cost, right? And you can only do that a limited number of time. So it's not really appropriate when you want to cover your operational costs, for instance. A much better capital efficient tool would be to open a credit line in a bank. But Web3 actors don't have access to banks, right? So if we want to continue and pursue in this, we need to, like I said, build the infrastructure tools in order to allow them to access such products. And I really think that it's possible to do so because by working on the blockchain, Web3 actors are much better debt holder than a traditional counterpart in my eyes. By relying on the blockchain, everything is transparent. So you have access to their financials. Auditing or opening financials becomes very easy and can be done in an instant. You have access to their accounts, wallets, financial stream. So everything is auditable, measurable, and you can monitor that in real time. So just that in itself makes you want to work with them and makes Web3 actors top actor you want to deal with. But that doesn't end here. You can actually integrate the whole loan life cycle through smart contracts. And when you do so, the underlying risk of default becomes the risk of the smart contract being hacked. And this is something you can actually measure by auditing it, or you can cover yourself from using an insurance protocol. So this is something this is why I think it's much more powerful, because you have a lot of real-time data and insights, and you have a measured risk of counterparty that you can totally cover yourself from. And now, if we look at how a typical under-collateralized lending protocol works today, you usually have two sides. Liquidity, the supply and the demand. The supply being the liquidity provider, LPs or lenders, name it. And on the borrower, on the supply demand side, we have the borrowers. So usually you have LPs which are providing liquidity in vaults or pools to earn an extra APY. And from that vault, you have multiple borrowers that are borrowing from it. And it's not really good, right? Because as a lender, you are exposed to many different borrowers. So the risk of counterparty is actually very high in this case. And the due diligence that is supposed to be performed by the borrower, the lender himself, with very little data available on the protocol to actually perform this the thing, which is also very tedious, very tedious activity to do. And lastly, the terms are negotiated by a third party, which usually is called a pool manager or a pool delegate, and the borrower himself. And this is also not very good because the third party is usually a centralized entity. And so it induces a new black box inside your DeFi protocol, which is kind of going against the overall value of DeFi in the beginning. And so that's why today I will be presenting you our first attempt at providing a better version of what exists on the market. And this is actually the first time I'm doing that publicly. So I actually recorded. I hope it's going to be, the resolution is going to be fine. Whoops. OK, so everything is deployed on Coven. And here you are on the main page of the protocol. This is the pool page. So you have access, you can see a various number of pools that are available on the protocol. And you can see here is XYZ DAO DAI, which is willing to borrow DAI for 2 minutes. Here you have XYZ DAO, which is willing to borrow USDC for 72 hours. Here DAI for 48 hours. And ABCD DAO, which is willing to borrow WETH for 48 hours. So we go by name, currency, and maturity. If you want to have some details, you can click here and you can see that XYZ DAO is an option trading protocol, accessing scalability of layer 2, blah, blah, blah. It's the same here. You have the same for Acme Corp. And on the pools, you have a few information, such as the status, the TVL, the credit limit, a few APYs that I will be talking about later on. And if you want to deposit, you actually come into the pool-specific page. So you still see some overall data, such as the status, which is open, the credit score, which is associated to the borrower. The description, you still also have the APY, so the pool TVL, active APY, reward APY, yield provider APY, the borrow limit, which is in this case the borrower is able to borrow up to 10K DAI. The pool utilization is 0% because the loan has not started yet, and the maturity 2 minutes. So I will be talking later about the various APYs, reward, but the active APY is the APY that you are getting from when you are matching with the borrower, and I will explain later how you can be matched and not matched. And the yield provider APY is when your funds are not used, not borrowed, or not matched, we take those funds and we place them on the yield provider. And the yield provider that we use mainly is Aave. So right now, the DAI on Aave is at 2.7%. So that's the yield that you will get. And here is the order book. So this is an order book of rates. So when lenders, you can see that it ranges from 5 to 15%. And so lenders will be able to actually select exactly the rate at which they are comfortable to lend their money to the lender, to the borrower. So you can see that the average lending rate in the pool is 6.5%, 6.3%, and there is 12K DAI in the pool. So I will be able to select actually the rate I'm actually comfortable lending, but you need to know that when we start filling the loan, we go from the lower rate to the higher rate. So if I put a yield, a rate which is too high, I might not be actually matched with the borrower. So that's why I decided to go for 5.5%. I wanted to deposit 1K DAI. So I approved the transaction to deposit my tokens. This is going to be the first transaction to deposit. And so what it will do is that, like I said, I want to be able to be matched with the borrower because I want to be sure to get the 5.5%. Because if I'm not matched with the borrower, I'm getting the 2.7% on Aave plus the reward. But I will talk about that later. And so here, as you can see, the transaction, the approval transaction went through. And so here we'll be performing the real transaction, which is going to basically deposit my position inside the order book. So the order book updated accordingly, and this position is represented as an NFT. So I can actually go into the withdraw panel. You have like the change rate, sell position, etc. I can find my position at 1,000 DAI at 5.5%. You can see that I'm earning my position is being rewarded right now. I'm getting 5.5%. And it's deposited at 5.5%. The time spent in the pool is less than an hour, etc., etc. So you can see the total reward that I'm earning, etc., etc. And if I'm actually not happy with the rate that I'm having, I can actually change it. And so I can go from 5.5 to actually 6%. And this is, you can see that it will update the interest rate, the weight in the tick, and the yield projection. And so obviously the yield projection is super low because here we are talking about maturity of 2 minutes. So it's very, very low. But you can get a sense that usually the maturity that we're talking about with real...
Hi, hello. Here, first row.
Oh, yeah, sorry.
Cheers. Thanks a lot for that. Very interesting. What for me was quite interesting is the credit rating bit. Obviously at the start, the credit rating bit.
Oh, yeah.
So at the start, you were saying how it's great that you can see everyone's transactions, everything, and then use it to compute that. And then you had the double Bs there in the demo. So what solution are you using? Is it something like Creda, or do you have something in-house? How do you get to the credit ratings to be able to then, for users to price the loans?
Yeah. Actually, we developed it. So we developed our own version of order book. And so the rate discovery is like what we call a fair rate discovery because it's done by the market. So that's why we don't need to have like pool managers, pool delegates to actually handle this because this is done strictly by the market. Yeah.
Thank you.
Hi, thanks for the talk. What happens when a borrower defaults on a loan?
Yeah, obvious questions. This is, I think, the question that I've been asked the most ever since I started the project. And so we obviously can't say that the borrower is never going to default because, I mean, in the market, there is no reward without risk. And obviously, here in this case, it's the same. So we built a framework which is trying to make sure that we can diminish the risk of default and counterparty as much as we can. So that's why we actually induced a credit score. So the credit score is based on the financials of the protocol or the DAOs, etc. There is some KYC and KYB involved. We have a legal framework which is around the protocol. So when the borrower is actually borrowing on the platform, the borrower is exposing themselves to legal consequences if it were to default. We're also talking to insurance provider because there is like an obvious link between what they're doing and what we're doing. So that we could launch insured pool in which the premium of the pool would be actually covered by the insurance protocol.
Okay, and the insurance protocol is not related to to your protocol, right?
Sorry, the insurance is not my protocol. That's what you.
No, is it a different, unrelated protocol?
Yeah, exactly.
Okay.
And that's where I think Web3 shines, right? Because by sharing the same backend, like working all on Ethereum or other blockchains, it's actually super easy to integrate with other protocols. So I can go see a credit scoring provider. It gives me a score. I implement it and show it on my UI. I integrate with an insurance provider. They insure my pool, and we go and see, I don't know, like a yield provider in order to. So that's like very easy to integrate with other protocols, and like you can build like a solution which is incredibly complex, but also very strong, robust, and capital efficient. And so that's why, like, I think you can also that's how you can really compete with Web 2 and what exists in the traditional ecosystem, because they, obviously for them it's a pain, right? Because they don't share the same backend, and doing that would take some years.
Okay, sorry for hogging the mic, just one more short question. The insurance protocol, does it give the rating to the pools, or you said fair market discovers the rating for the said pools, right? So how does that work with the insurance protocol?
Your question is how basically the insurance provider is rating the pool or doing the policy of the pool?
I'm just asking if it's the insurance protocol that's giving the ratings, right? Is it?
Do I need to whitelist it?
No.
I'm sorry.
Where do the ratings come from? That's the question.
Where does the rating come from?
Yeah.
From the insurance provider perspective, or for the credit scoring provider, or because basically at the end of the day, when you are talking about risk, if you are talking about the insurance provider, they have their own team, which are credit analysts, risk analysts, which have their own model, and so they are analyzing the risk themselves, and that's how they're actually drafting the insurance policy, right? They basically go on analyze, they take the model and say, okay, this is what insuring the premium is going to cost us, and this is all fee, and you have the policy which is drafted. On the credit scoring provider side, well, they have their model as well, and they I don't know, I have access to the financials of the protocol, some legal documents, etc., etc. At the end of the day, the more data you manage to get your hands on, the better it is in terms of credit scoring.
Okay, thank you very much.
Thank you.
Hi. I just wanted to ask you, do you have any plans to do borrowing to individuals? Because at the moment, I understand it's only to institution businesses, yeah?
Yes. So, I mean, you see all the questions that I had for corporates, right? So imagine now lending to individuals. So obviously, that's something that we were thinking about doing in the beginning, that we quickly decided not to do, because it is obviously very, very risky. And that's why it's working this way in the market right now. That's why everything is over-collateralized, right? Because this is the main way that we actually managed to kind of break the trust circuit in that. But I mean, there are some ways using ZK knowledge proof, and there is some products that are building identity products, so that your Web3 identity, you can bring in on-chain and leverage it to actually use it as collateral. Those products are very immature yet, but I think there is a great potential in this area. And once those products will be very mature and production ready, I think we will be able to actually use them to allow individuals to have access to loans this way.
Thank you.
Thanks. Okay, cool. Thank you very much. Was we're going from few days to few months. And so you can see the order book has been updating accordingly. So you have the sell position panel as well. So in order to, you can sell your NFT on a secondary marketplace such as an OpenSea, Rarible, etc., but you can do that only while the loan is being borrowed. Right now, it's not the case. You have here the pool details panel, pool history, where you can see a lot of information. You have your dashboard, which sums up your whole of your positions that you can manage directly into that. The history panel as well. And that pretty much sums up the lending side. So remember, like I'm a lender, and that's what I've been. I was doing here. I was lending my money, and here we are on the demand side. So the borrower. So this is I've been whitelisted as a borrower, and here is my pool panel, and so I can actually manage my loan through this panel. So I still have access to the order book. I can borrow 10K DAI, and so you can see here what I will be borrowing. If I borrow 5K, I will be borrowing at 5.8%. So we start from the lowest rate and we go till the higher. So here at 8K, I will be borrowing at 6.1%. And if I borrow the whole thing, I will be borrowing at 6.3%. So you can definitely see that what I will be borrowing and what will be actually put on Aave. So the 7% and so the remaining of the 6.5% and 7% will actually be put on Aave to get the Aave's yield plus the reward APY that we'll be talking about in a few minutes. So you can see that the transaction went through, and now the status of the pool changed. So the pool is borrowed. The funds are actively being matched with the borrower, and those parts have been placed on Aave. You can see, as a lender as well, the status changed on the pool. So I'm aware that the color changed a bit, so that I'm aware of the loan life cycle and what happened. And if we now go back on the borrower admin, I actually now, so the maturity of the loan is 2 minutes, so I will need to pay back in 2 minutes. And so here is the reward panel that I was talking about. So the reward panel is a reserve that the borrower can actually put some DAI into and crypto into to boost the APY of its own pool. So basically, it's incentivizing lenders to come here to get a higher APY. And this APY is distributed only to lenders that are not matched with the borrower. So this way, it's not only equal to lend on a protocol than to lend on Aave, it's actually strictly better. And here you have the same, you have the pool history, so you can see that the borrower has been borrowing for 40K at 6.3%. He has some analytics as well, and some governance and borrowing addresses that are displayed here. So that is sure that everything is going right with its pool. Oops, sorry. And so here now I will be, shortly I will need to repay my loan because, yeah, you can see that the status of the pool changed again. So now I'm in repaying time. So you can see that I've been borrowing 10K at 6.29%. I have a few interests to pay. I have obviously a fee as well to pay, and so you have the total, the breakdowns and the total that needs to be done, so to be repaid. So I will be first approving my tokens and my transaction to be performed. And when it will go through, I will be performing the new transaction, which will basically repay the loan. And once the loan will be repaid, assets will be, the pool will be unlocked. So it will, I'm sure you guessed it, but change the status of the pool again. And the pool status is going to be moving from repaying to cooldown. And the cooldown period is a period in which the borrower can't borrow again, and it's a period which is made for borrowers to lenders to actually hop in and out freely in the pool to make sure that they can change their positions or exit the pool freely. So here you see the order book updating accordingly. Now funds are not matched anymore, and funds are directly placed on Aave. It's going to take a bit of time to actually update, but essentially what you will see, I think, yeah. Now the status changed, and it went from, like I said, repay to cool down. And that's basically it. So that we went through the whole loan life cycle, and yeah, that's about it. So yeah, thanks a lot for your time and your attention. I really hope that it was informative to you, and if it was interesting, don't hesitate to to come and talk to me, follow Atlendis Labs, or reach me out on Twitter. Thanks a lot.